value of the total supply and multiply by the total residual input tax. That is your recoverable residual input tax, which means that you can claim that portion as input tax from the government. Now, if you are not a Reg 34 business, not a bank, but a normal business, but you don't satisfy the Reg 35 test, in this kind of situation, then the amount that you can recover from the residual input tax will be equals to the total residual input tax multiplied by the value of total taxable supply divided by the value of total supply. Now you realize that the part on Reg 33 exempt supply is missing because you don't satisfy the Reg 35 test. And therefore, the input tax that is attributable to those Reg 33 exempt supply unfortunately cannot be claimed as a recoverable input tax. Now, this is all I wanted to share in relation to the input tax on how we can claim. Now, I'm going to use the rest of the time to go through some examples of GST questions in the Singapore CA paper. And I'm using the June 2023 question 3 as an example. So in this question, we have TSH, a Singapore incorporated company, is a wholesaler and retailer of party supplies sourced from America. It sells directly to retail customers via its website as well as through its retail outlet in Singapore. TSH is a goods and services registered company that is currently entitled to a full input tax credit. It has also opted to apply a reverse charge on all its imported services. The following transaction were conducted in the quarter ended 30th September 2022. Unless otherwise stated, all purchases made in Singapore were from GST registered company, and all expenses, sales and income values stated are exclusive of GST. So I'm going to pick on a few questions that is highlighted here in the red box, and to see what is the GST implication after we have, by applying what we have learned just now. So the very first one here, it's a transaction where there is a sale of party supply, where delivery were made from Singapore during the quarter. There is a sale of old stock that worth 480,000 to Singapore customer before a 20% discount was given, and the GST is absorbed by TSH. Now, bringing back all that we have learned just now, we have to means that we have to think of, can I claim the GST back? Now, this is obviously a sale of goods. And because it's a sale of goods, remember what we have shared just now, we look at the beginning location and the ending location of the goods. In this example, the beginning and ending location are in Singapore. And therefore, the type of supply is a standard rated supply. In this case here, we are talking about 2022 GST filing. The GST rate is at 7%. Do note that 2023 is at 8%, 2024 onwards, it's at 9%. Now we have ascertained the type of supply. We now need to know what is the value of supply. I apply this 7% on what value? Now the value of supply here is the consideration. And the value of supply here is 80% of the 480,000 because we give a 20% discount. And we know that here the GST is absorbed by TSH, which means that 80% of 480,000, that amount represents 107% because TSH absorbed the GST amount. We then have to recalculate the value of supply by dividing the balance by 107 and multiply it by 100 to find out what is the base value before GST. and that amounts to 358,879. Now, if this is the value of supply, what is the output tax? The GST will then be simply 7% of 358,879, and that gives me 25,121. And that amount is the output tax. We use the same concept and the same flow for the second transaction. There's a sale of 50,000 made to a Singapore customers where the goods were delivered to their related companies in Malaysia. The party supply will the beginning location is in Singapore. The ending location is in Malaysia. It's outside Singapore. And for this is a zero-rated supply. The value of supply is 50,000. The GST amount is 0% of 50,000, which is $0. And this is an output tax. The next one here, we have also a sale of 15,000 via their website made to customer with a foreign IP address, and goods were delivered to a Singapore address. This is again a sale of goods. The beginning and ending location are both in Singapore. The type of supply, therefore, is a standard rated supply. The value of supply is 15,000. We apply 7% on 15,000. That gives us $1,050, which constitute the output tax. Moving on to the next one here, where there is a rental income of 12,000 for the quarter from the sublet of office space. The annual value attributable to the sublet office space is 24,000. This is an income in relation to non-residential Singapore property, and therefore is not an exempt supply. All right, this is a standard rated supply. The value of supply is the amount that you have charged, which is 12,000. The GST is 7% of 12,840, and that constitutes your output tax. Now let's take a look at an expense, a purchase. This is an advertising expense of $500 relating to the sublet of office space that we talked about just now. This is a purchase of service, and therefore we have to shift away from the logic that we talked about just now, which is a sale. Now we're looking at the service, purchase. When it comes to purchase, and in exam, we have to first determine from the supplier perspective. So we put ourselves in the supplier's shoe and ask, what type of supply is this? This is a standard rated supply, as all services is done in Singapore. It is not international services. And therefore 7% of GST applies. Do remember it's 7% because we are talking about 2022 year. The value of supply to the supplier would be $500. That's how much he charged. And the GST that is chargeable will be $35, which is 7% of $500. Now, after we have ascertained from the supplier perspective, we can then move back to the company TSH perspective. From that supplier analysis, we would then be able to determine that TSH has paid a GST of $35 to the supplier. And this would be a standard rated purchase because the supplier charged TSH as a standard rated supply. Now, from a TSH perspective, we have incurred $35 of GST. The next thing we need to do is to ask ourselves, is this GST, the input tax here, linked to a taxable supply? And we understand that this advertising expenses is linked to an office space, which is non-residential. It's a taxable supply. So we check the box. Next, we ask whether is this transaction here being blocked by Reg 2627? Answer is no, it is not blocked. None of the listing there talks about advertising expense. And therefore, TSH will proceed to claim the $35 as an input tax from the government. So in short, these are some of the example and the concept of GST that I've shared previously. So I hope you have enjoyed the session and you have learned something out from this GST webinar. I thank you so much for your time to listen in, and I hope you have a wonderful journey in understanding more about GST. Thank you.